now? What is it that they're buying? What is it, and what's the rationale behind some of those bids that we've seen into some of these rallies?
I actually, think that this is just a lot of year-end positioning, cleaning up with tax loss harvesting, and maybe rebuying. Some of the losers to the extent that people think they're going to rally into the new year. Very often a common strategy is, in the new year, buy whatever was down quite a lot the year before. And, in certain circumstances, that works. I think the fundamental issue, from where we sit, is what is the controversy going forward? And I don't think the controversy is anymore simply, what is the Fed going to do? I think the controversy is shifting to what is the impact of what the Fed has already done. And we know that policy operates with a 6 to 9 month lag, which means that as we get into 2023, the reality of one of the fastest rate hiking cycles in the last 50 years is going to play out. And I think that's where there's debate about whether that means a lot of slowing or a little bit of slowing.
So, Lisa, I like your point that basically maybe we're just living through a lot of window dressing right now when you look at the day-to-day price action. But we're heading into a big week next week, really the last week that matters in 2022. Is there anything that you could see next week between the economic data, between what we're going to get from the central banks, not just from the Fed, that could change or shift your outlook for 2023?
No, I don't think our outlook is going to shift a lot. Obviously, I think the CPI numbers, it's critical for the narrative that's currently baked into the market, which is that the Fed is slowing down and that we are going to attempt a soft landing next year. That means the CPI number needs to continue to sequentially cool down. Our best guess, based on the inputs that we look at, is that probably will happen. If it doesn't, that will be a surprise. I don't think it takes the Fed off course, but it will force Powell into reiterating this more hawkish rhetoric of higher for longer.
Has the market taken that seriously, specifically the equity market? Because when you look at valuations here, there are a lot of people that would look, whether it's at current P's or even looking out 12 months now, to say that they're still too high, even in some of the more best case scenarios, I guess the softish landing scenarios, and certainly maybe too high if we do head for the worst case scenarios.
Yeah, we're in the camp that current price earnings ratios are too high. If we normalize this price earnings ratio for normal, what we call equity risk premiums, given the level of 10-year rates, it really means that this is a market that believes that 10-year yields within the next 6 to 9 months are going to be trading below 2.5%. And since we're in the camp that says real rates, meaning real growth, and inflation are both kind of renormalizing during this cycle, we're not sure that betting on a 10-year that's through to 2.5% without a recession is a good bet. Now, if we get to 2.5% on that 10-year because the world is worried about us going into recession, I don't see how stocks defy that.
I want to talk about the 10-year yield a little bit more, because there was a huge call from Wells Fargo that, given where your inflation sort of premium is, if you look at the structurally higher policy rates that could be needed to cool it, that maybe the 10-year Treasury yield should be closer to 4.75. And we haven't seen levels like that since 2007. But obviously, there's a lot of daylight between 2.50 and 4.75. Do either of those numbers seem reasonable? Where do you fall in that range?
So our best guess is that we're pretty fairly priced on the 10-year right now at roughly 3.5%. That strikes us as kind of where we're going to end up in this next business cycle, which is about 2.5% long-run inflation and about 1% of real positive growth. And so, look, our best guess is, like I said, if interest rates are undershooting that 3.5 materially, it's because probabilities of recession are going way up. In addition, if we're, wrong on the low side and those 10-year rates are closer, to the forecast of 4.75 that you referenced, that's also not going to be a great recipe for stocks. So one of the arguments that we're making in our more defensive call to be skewed overweight bonds versus stocks in 2023 is just there's more ways to win in bonds next year than there are in stocks. Stocks right now have to thread that needle with rates kind of sort of staying where they are and this soft landing playing out. Because if things are much hotter, stocks are going to lose on the multiple front, and if rates are much lower, it's going to be because we're headed towards recession, and the earnings are too high.
Well, with regards to allocation into that fixed income space, I mean, where's the activity? Is it basically just people buying bills and shorter term treasuries, or are they willing to sort of go a little bit further out, buy some of the longer term notes?
Well, we're trying to encourage people to take a good hard look. We do think that there's some really good opportunities to clip coupon in the 4.5, 5, even 5.5% levels in the investment grade corporate credit market, in the municipal credit market. Tax adjusted. Those are going to be satisfactory yields with the potential for positive total return next year if, in fact, growth slows and rates drift lower from where we're at.